When businesses need funding, they usually consider two main options: debt financing and equity financing. Debt financing means borrowing money through loans or bonds and paying it back with interest. One big advantage of debt is that the original owners keep full control of the company since there's no sharing of ownership. Interest payments are also tax deductible in many cases, which can lower the overall cost of borrowing. Plus, debt usually comes with fixed payment schedules, making it easier to plan the company's finances. However, debt has some downsides. Companies must repay it no matter how well the business performs, which can create pressure. High levels of debt can also increase financial risk, especially during tough times. Access to debt depends on a company's creditworthiness and collateral, which can limit borrowing options. Apple is a good example of how debt can be used strategically. They have borrowed large amounts at low interest rates to fund share buybacks and dividends, maintaining control while benefiting from tax advantages and preserving cash. On the other hand, equity financing means selling shares of the company to investors in exchange for capital. This avoids the pressure of repaying fixed amounts since there's no mandatory repayment. Equity investors share in the business risks and can offer valuable strategic partnerships and networks. The downsides include dilution of ownership and control, which means founders may lose some decision-making power. Equity is also usually more costly than debt in the long run, and profits must be shared with new shareholders. Tesla shows how equity can support rapid growth by raising funds through share sales, avoiding the burden of debt during a volatile and ambitious expansion phase. Choosing between debt and equity depends on factors like the company's stage of growth, risk tolerance, cost considerations, and how much control owners want to keep. Each financing method comes with trade-offs that leaders need to carefully weigh to make the best decisions for their company's future. Mature firms often lean toward debt because it offers tax advantages, but the choice really depends on several factors. Stable and predictable cash flows make debt a safer option, while companies with more volatile revenues might prefer equity. Growth ambitions also play a big role. Businesses aiming for rapid expansion may opt for equity to avoid taking on too much debt and the risks that come with it. Market conditions matter too. Low interest rates make debt more attractive, whereas strong equity markets encourage raising funds through shares. Founders with a strong desire to retain control might avoid equity to prevent dilution. Many companies find a balanced approach works best, combining both debt and equity to balance cost and flexibility. Hybrid instruments like convertible bonds and mezzanine financing provide more options. For example, Amazon initially used mostly equity during its early growth but later incorporated strategic debt to finance infrastructure without giving up control. Ultimately, debt and equity decisions shape not just finances but governance, risk, and the company's strategic path. The right choice matches the company's vision, risk tolerance, and market environment, helping support sustainable growth and maximize shareholder value.